All right, folks, so I have a case study right in front of me here I would like to share with you, and it's not always how it seems, and we have a mental trap. And let me explain. So whenever you speak to someone and when they say, hey, I own multiple properties, all of a sudden the perception, the imagination, the mental trap is, wow, that person is rich, is wealthy, is dealing with all these properties. It's, what am I going to do about that? And all of a sudden you become depressed, you become unhappy, you become unworthy in your head because you're like, oh my gosh, everyone else is trying to maneuver through this planet, world, life, etc. And I'm worthless because I'm not doing anything, or I cannot do anything, and how come others can and I cannot, and so on and so on and so on. So I do have a couple of slides I would like to share with you, and just to share this case study, I did change the numbers a little bit, right? So it's hard to pinpoint exactly to the last dollar because that person actually spoke to me, opened up, and they just told me their story. So I just wrote it down in a bulletin point form, and I would like to put it in a graph. So it's not 100% accurate, but you will get the picture, right? This person purchased 4 condos. And they did not purchase these condos within, 2020 and 2021, the hype and the ultra sky high and all of that stuff, right? Like they started way back, right? But the accumulation and that trap, I would say, of being, I'm not going to call it misled, but being educated in the way where every time you see a little bit of equity in a property, you withdraw it and you sink it somewhere else. You double up basically, right? So that's what I would like to share with you. And you will see that sometimes not doing anything is much better off than doing everything, especially things that you have no idea what you're doing, right? It's either you speak to an expert, and that's obviously I would say questionable. Who is an expert nowadays, right? Like that's like you really have to know. So what I would like to say is like you have to take everybody's opinion, but you have to trust these people that actually walk these paths and they have something to show and they can actually prove it and they can show you a system. So that's my opinion. But let's get into this slide. All right, so as you can see here, it says the refinance trap. We'll talk from 2015 to 2025, and then we will go onwards from 2025 to 2030, because I'm breaking this up since many of you guys said these questions. Like, we know what happened up to 2025, and then what will happen from 2025 onwards, right? So it is not as simple, or it's hard to put it in a 5-10 minute video. However, I would like to show you the build up to 2025, because that will determine heavily what happens from 2025 to 2030. So a decade-long story of leverage, refinancing, and diminishing returns. Each condo funded the next from equity extraction to negative cash flow, which is like very common in the marketplace. The illusion of growth and systematic financial fragility. Let's get into the first slide. So the first condo breakdown, purchased in 2015, the purchase price was $400,000. The loan on that property was $320,000. Equity extracted for the next purchase, right? Like when they settled in, was somewhere around $100,000. And I believe that happened when that particular property saw that equity jump, equity boost, right? So then they took out that $100,000 for the down payment for the condo number 2. And at that point, the condo was rented for $2,400, and the net cash flow was negative $658. Now, when we go to condo number 2, purchased in 2018, purchase price was $550,000, loan $440, equity extracted $140,000, and there's just like the equity that the equity grew a little bit and all that stuff for the next purchase. So current value is somewhere around 550 if we would trace it back, and loan to value is at 80%. Rent is $2,650, and net cash flow is negative $1,218. All right, so when we get to condo number 3, we see that it was purchased in 2023, and that purchase price was $640,000. Loan was $512,000. Equity extracted was zero, right, for the next purchase, because the value was at $580,000. So loan to value was 88%, more or less, and that current property was rented out for $2,600, and negative cash flow is at $1,606 a month, right? So why did they not extract the particular down payment for the next condo, which is number 4, which was a pre-construction? Well, because the equity at that point it wasn't there, right? Because the condo was purchased at $640,000, and the value diminished, or it went down, could not appraise, I'm assuming. So it went down to $580, and we're looking at $1,600 negative cash flow, right? So now the condo number 4, purchased in 2025, we see that it was purchased for $740,000. Loan was somewhere around $480,000. Equity extracted zero for the next purchase. Current value was sitting around $600,000, and not rented. Projected value drop risk is extremely high. So in order to close, parents have to step in as borrowers. Hidden cost that it's not shown in this particular graph. Returning of funds are questionable, and it is not offsetting the graphs yet, right? So we'll get into some graphs in a second. But even the down payment that was 20% of the down payment, it is hard for me because I didn't get into that much detail. But you see here, I don't know if the money was borrowed from parents just to cover that 20% for the developers and the builders for the condo before taking these keys. I'm assuming that was the actual case at this point, and it's not showing in the graphs because it's not a bank. It's borrowed from the parents. Whether they're going to ask money with interest or money period, I really don't know. But even to close on this particular one, they need an additional $140,000. So portfolio value trend from 2015 to 2030, we can see that the portfolio trend for in this particular case, we can see that it shot up beautifully, and then it peaked somewhere around 2018. And at that point, yes, the actual portfolio is booming, and from the outside it looks fine and dandy and beautiful and rich and sophisticated, right? However, within, they're broke, completely broke, and they're probably saying in their head, oh my gosh, I should have done that. I should have maybe stuck with one and tried to pay it off as soon as possible because they got in 2015. I don't know what they're thinking, but when this particular trend all the way to 2030, probably by my prediction, this is my personal prediction, please do your own due diligence, but I think we will see definitely more drama in the market. Definitely the prices will sink even more. All right, so equity ratio decline, falling real estate ownership due to over leveraging and refinancing. And we have seen that, right? exactly what I was saying. In 2015, we see that particular person was in the green. It was awesome, and then it kept declining, 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 and then when they got to the second or third condo, they're already up to here in debt. They're just, dealing with the negative cash flow, dealing with tenants, right? Dealing with refinancing, dealing with borrowing, from one place to another, right? And then for some odd reason, probably at this point, praying and hoping that, you know what, the market will turn around and that equity will skyrocket, because in their head they're probably saying, look, if I have four of these chips or four units on the table, once the equity switches, right? Like, let's say each property goes up in value by 10%, right? Oh my gosh, on each condo I'm going to cash out 50, 70 or $100,000 of equity. That's what I'm assuming is happening in their head, right? Because they're it's times four, because they got four units, right? If they had one unit, it'll be like, okay, 10% on one unit. But they have four units. Here you go. So it's a jackpot, right? So that's the mentality. That's the trap of having all of this and being broke, unfortunately, right? So when we see the graph and when we're looking at the graph, like that particular portfolio or this case will be in the red probably forever, right? And when I say forever, a decade is long enough, because if you have never experienced that type of pain, like where like you're dealing with something, it's still coming out of your pocket. You're in jeopardy on every single possible end or scenario. It's draining mentally, physically, financially, right? So it's very stressful, right? So anyways, so in this scenario here, just visual representation, how it looks, right? And you see the first condo is like 79% leveraged, right? And the second one is 80%, and then the third one 88%, and then the fourth one is leveraged at 123%. And I'm assuming that at this point, like that probably 20% of down payment that came from parents or help, third-party solutions, right? It's not embedded in this graph as well, right? Because I'm speaking to this person, it's kind of like touchy, like it's still a personal portfolio, right? Like, but like I read a little bit between the lines and stuff like that. They were honest, right? And these are kind of the numbers here, right? So, and that fourth condo can sink all of those condos together, because think about it. They're over leveraged on every single one. And then the fourth one is boom, slingshot, jackpot. That's it, right? That's the drop, right, in the bucket, right? So that's why I'm saying all the time, like, even though we have different sectors, we have commercial, we have detached real estate that's kind of detached from all the real estate, we're assuming. No, it's attached to a pre-con condo, to another condo, to an investment, maybe to a property in Florida, maybe to a property overseas. Who knows what it's attached to? But for some reason in our head, we assume that, okay, so that's the detach and that's completely safe and nobody can touch that, right? Are you kidding me right now? Everything is volatile. Every single unit, property, case, business, you name it. It's volatile, it can break, and that's it, right? So anyways, total exposure exceeds $2.4 million with 17% of negative effective equity, a clear case of compounding risk when it comes to leverage, the illusion of wealth growth, mass systematic fragility across four leveraged assets. All right, if we move on, this is debt versus market value from 2025 to 2030, because we built a case, right, from 2015 to 2025. So that's a decade. So let's see what will happen in the next 5 years. And by this graph and by the projection, right, probably the properties will feather down or they'll be stuck or whatever the case is, right? Like maybe we'll see another 3 to 5% each year, right? Which at the end of the day, by 2030, we could see another 25% off of current condo real estate prices, right? So at this point, like, like that particular person is just holding death, like right here, plus more, and everything else is slowly sinking, right? All right, so next graph is showing a representation of annual negative cash flow and what that looks. A lot of people do not take this into consideration, but I'll get into it in a second, right? Like you see the graph here in 2015 when they started, they were very, very minor at the beginning, minor negative cash flow, or maybe even breaking even at that point, right? But as you go on to year 2030, you see it's like compounding, right? And you say, well, hold on a second. It's like that's not true because I can raise my rent and I can do this, that, and the other. And I agree, right? But you see here on this graph, future outlook, rent growth is roughly around 2% annually, lags behind expenses inflation by at least 5%. Annual losses compounding between $35,000 to $45,000 per year by 2030. Refinancing impossible with negative loan-to-value ratios. Parental loan adds new personal liability outside the bank or the banking system, right? So that's something else to think about. I don't know how they're going to sort that out, right? But it is what it is, right? So if you're looking at this particular graph, right, if a fridge breaks down, if something goes wrong, and a lot of people say, hey, look, it's condos, right? Like it has, maintenance fees. Yeah, I agree with you, but they go up, right? Every single year, it seems like, right? Like in every single building, they have another project that they have to finish. They have another fund that they have to fix, and they have another this and that and the other, right? So there's always that percentage that goes up. And if you order your status certificate or you get it in the mail, you'll see that there are projections, right? But those projections are not, how am I going to say, that rent cannot cover these projections because they're usually higher, right? And then you add that, then you add taxes, annual taxes on properties that usually go up, right? And then you add the fact that you cannot demand certain price points or certain level of rent, so you're in a negative cash flow. Then you add the fact that the properties are not growing in equity value. Then you're adding the fact that if you sell it, there's cost associated, right? Then you're adding the fact when you bought these properties, you have to pay land transfer tax, you have to pay lawyers, nobody's calculating that. And these are thousands and thousands of dollars, right? So all of that put in a bag, I can comfortably say, unfortunately, that this person is bankrupt, right? And yet, when we are sitting around these square and round tables in gatherings, and we see these people talk about how they own 4 condos or 6 or 3 and how they're masterminding, I'm like, oh my gosh, you're broke. That's all I got to say. That's it. Very simple, right? With all the respect, I'm not trying to bash anybody here or anything like that. I'm just saying, let's call it how it is, right? And I've been making these videos, right? Like, and a lot of comments, people agree, people see it, people are walking with their eyes open and all of that stuff. Other comments are different. They're like, listen, you're out to lunch, you don't know what you're talking about, this and that and the other. Fine, I get it. I respect all the comments. But I'm saying, prove me wrong. I mean, the numbers are here. Prove me wrong. We have been in a declining market since 2022, and every single month there's another boom in June or whatever, right? So it's just like it's incredible. It's incredible that mental trap. I don't know if it's associated with maybe fear or hope that it will somehow quickly shift and they will, like, I just don't get it, right? And I have seen these portfolios before, and I asked a question to each one of them, and I asked this particular person the same question, and the question goes like this: if I had the ability to clear all of the debt on these 4 condos and give you your money back, the initial 20%, whatever they gave in 2015, would you take it today? In a heartbeat. They said, you know what? At that time, I think it was like $80,000 or $90,000 for the first purchase, right? They said, I would gladly take the 80, 90K today and get rid of all of the condos in a heartbeat, right? So it just shows the stress, and this is the actual truth. The numbers, as mentioned before, are not 100% accurate. This is an exercise just so we can kind of see what is going on, but this is reality. This is happening to many Canadians. All right, so the final takeaway: the equity illusion. Real estate wealth without liquidity is a mirage. Financing borrowed from future stability to buy present expansions, very dangerous. When the math stops working, the dreams stop too. Leverage does not forgive. So I hope you got something out of this video. Please share to somebody that you believe or think that should hear this particular message, and like, share, and subscribe, and I'll see you in the next one.